Welcome tax professionals, chartered accountants, students, and business owners to this explainer. Today, we're diving straight into Section 132 of the newly minted Income Tax Act 2025.
Let's kick things off with a practical question you are definitely going to hear from clients this season. Can buying an electric vehicle actually lower your tax bill under the new statutory framework? Well, the short answer is yes. Let's look at exactly how taxpayers can leverage green choices for some real tax savings.
Here's our agenda for today. We'll briefly cover the introduction to the new law, break down the specific statutory conditions, walk through a practical taxation example, hit on some compliance issues, and wrap up with key takeaways.
Part 1. Introduction to Section 132. Bridging the old and new tax regimes. Let's set the stage. If you've been practicing for a while, you're probably very familiar with Section 80 EEB under the old 1961 Act. Well, that provision has essentially been picked up and structurally integrated right into the 2025 Act as Section 132. The core policy intent hasn't changed a bit. It's still all about incentivizing the adoption of electric vehicles by offering tax relief on the interest you pay on EV loans. Moving to Part 2, breaking down the law, statutory applicability and key elements.
Let's unpack the actual statutory language here, because the details really matter. First off, this deduction is exclusively for individual assessees. That means HUFs, partnership firms, or corporate entities, they are completely out of luck. Next, the deduction applies strictly to the interest payable on a loan, not the principal amount. Third, you can't just borrow the money from a friend. The loan has to come from a recognized financial institution like a bank or a specified NBFC. And lastly, the purpose of the loan must be exclusively for purchasing an electric vehicle.
Now, you might think you know what an EV is, but the Act gets highly technical here. To qualify, the vehicle has to be powered exclusively by an electric motor and a traction battery. But there's a catch. The statute literally mandates the presence of an electric regenerative braking system. You know, the technology that converts the car's kinetic energy back into electrical energy when you hit the brakes? If the vehicle doesn't meet this exact mechanical definition, the deduction completely fails.
All right, here is the golden number you need to memorize. 1,50,000 rupees. That is the absolute maximum deduction allowable for interest paid in any given tax year under Section 132. So even if your client is paying, say, 3 lakhs in interest, the statutory cap firmly restricts their tax benefit to 1,50,000.
And timing is everything. As a professional, you must rigorously verify this time frame. The financial institution must have sanctioned the loan strictly between April 1st, 2019 and March 31st, 2023. Notice I said sanctioned, not disbursed, and not the vehicle delivery date. If the loan was sanctioned on April 1st, 2023, the assessee gets absolutely nothing under this section.
Part 3. A practical taxation example. Computing the Section 132 deduction. Let's put some real numbers to this. Take a look at Mr. X here. In year 1, he pays 1,80,000 rupees in interest. Because of our hard cap, his allowable deduction is limited to 1,50,000. That excess 30,000 rupees, it permanently lapses. You cannot carry it forward. Now, moving to year 2, his principal is a bit lower, so he only pays 140,000 in interest. Since that's below the cap, he claims the full 140,000. In year 3, he pays 90,000, and again he claims the full 90,000. It's a pretty straightforward calculation once you understand the limits.
Let's move to Part 4, Compliance and Common Issues, Navigating Pitfalls and Procedural Nuances.
A major compliance shift you need to be aware of under the new regime is terminology. As clarified in the official transition FAQs, what we used to call the previous year under the 1961 Act is now simply referred to as the tax year under the 2025 Act. It aligns perfectly with the financial year. So, the year you earn the income and pay the interest is the exact same tax year you use for claiming your deduction.
But here is a massive trap you really need to warn your clients about: double dipping. Section 132 strictly prohibits claiming this interest deduction if you're claiming it somewhere else. For example, if a client uses their electric vehicle for their business or profession, they might naturally try to claim the loan interest as a standard business expense. Well, they cannot claim that same interest as a business expense and simultaneously claim a deduction under Section 132. They have to choose one.
To make sure these claims actually survive an audit, you've got to follow a few simple steps. First, verify the actual loan sanction date on the bank's official letterhead.
Second, obtain the definitive annual interest certificate directly from the financial institution. Do not rely on estimates or EMI schedules, because those blend the principal and interest together. And finally, ensure the deduction is accurately filed for the correct tax year.
Finally, Part 5. Key takeaways and summary. Consolidating Section 132. Let's do a rapid-fire recap to cement this in your practice. Section 132 replaces the old 80 EEB. It is strictly for individuals. The absolute hard cap is 1.5 lakhs per tax year on the interest. The loan must sit firmly inside that specific sanction window of April 1, 2019 to March 31, 2023. And remember, watch out for that double deduction trap if the vehicle is used for business.
So, with that 2023 sanction window now firmly in the rearview mirror, it makes you wonder, will future budgets introduce a new deduction window, or is the era of tax-subsidized EV loans over for good? Let us know your thoughts in the comments. Thank you so much for watching this explainer. Please like, subscribe, and share.
This explainer is for educational purposes only and does not constitute professional advice. Tax laws are subject to amendments. Please consult your professional advisor before taking any action. This is an AI-generated educational explainer.